Welcome to Hitting Home. I'm your host, Arif Khan, and it is my pleasure to be with you wherever you're catching this, at home or online. Thanks for joining. If you've been following this series over the last several years, you'll know that we've taken a lot of time and pride to try to understand the market, understand home ownership, understand household finances, and do our best to study the data and present good ideas for your consideration, regardless of what season we're in. And well, we're certainly in a season, for those of us who are paying any attention to our household finances or our bank accounts, etc. I think we can all agree times aren't necessarily easy, whether that's at the grocery store, at the gas pump, taxes, etc. We're certainly in a season, and that's why I'm thrilled to have with me today on Hitting Home a fantastic guy, a friend of mine, and an agent who has an extra special set of skill sets when it comes to mortgages and financing, and that's Ben Oakes. Ben, thank you so much for joining me on Hitting Home. Your specialty, obviously, in investment and construction financing, and I thought it would be a great idea to have you. I've been wanting to get you on the show actually probably now for a couple of years. I think now is a great time to have you on the show. Welcome, and I'll tell you why I'm glad you're here in a second.
Hey, Arif, thanks so much for having me on here. You know, we've chatted a couple times. I feel like we both approach our business the same way, by providing value to our clients and leaving them up to choose without giving any hardball sales pitch. So that's why I really relate with you, and I'm happy to be on here today.
Well, thank you. Thanks very much. That means a lot. I am glad to have you on for a few reasons. I touched on the term, and what you really specialize in is mortgages and real estate as a financial vehicle, as an investment vehicle. So a little bit of a shift or a switch from what we often talk about in terms of personal consumption or personal use. But the fact of the matter is that now is a great time to be having this conversation. Now, to our audience at home, I'll throw it over back to you, our audience at home. You probably remember that we've been talking about several times about kind of disregarding or not spending too much time paying attention to the headlines, not paying too much attention to what your friends and neighbors are doing, but actually taking a deeper look inside at your own personal scenario, your unique scenario, and readying yourself for either the opportunity or the challenge ahead. So, Ben, that's what I really want to talk with you about. But let's set some of the baseline, if you don't mind. Let's take a couple minutes in this first segment and set some of the baseline about where we are today as Canadians. And give me your read on the market, if you will.
You know, it's really exciting and timely to be speaking with you here today, because as we were chatting about before, I think the market is slowly starting to come back on. The lights are turning back on. And so whether you're a homeowner looking to move up, or an investor who's been sitting on their wallet for a little while waiting for the right time, it's very exciting to sort of see opportunities start to present themselves, and if you're well positioned, you can jump on one.
Absolutely. So let's again talk about that. For anybody at home might be going, hey, that sounds nice, guys, but that's not me. Let's break it down a little bit. I don't think that it would escape anybody in terms of having paid attention to some of those headlines that I said. Maybe don't pay too much attention to them, but if you are paying attention, when you say sitting on your wallet or sitting on your money for a little while, I think it's pretty clear that investors and the market has been doing that. And so to put that into plain English terms, I think we can all agree, certainly in our local area, Barrie and Simcoe County, or Ontario as a whole, we know, we've been reading the headlines, condo sales are down, new developments are down, developments have stalled, developments have gone bankrupt, developments got themselves in trouble even here locally by trying to reach out to the people who signed on the dotted line during pre-construction asking for more money. And so there's been some insolvency or projects that were upside down because of inflation, maybe because of poor budgeting and management, maybe because someone didn't have a crystal ball. But the fact of the matter is that whether it's you and me personally or the market in general, I think it is a fair statement that on the business side, people have been holding tight. And on a personal side, I think we can also say, I think you'll agree with me, that the inventory has really slowed down in the last year in terms of what's available for personal consumption.
Absolutely, most definitely. And I think there's two different tiers there to examine. I mean, one of the reasons the developers are slowing down is their product is available cheaper in the current retail market. And you can't sell a price down the road in a year or two closing when you can buy what you're offering cheaper today, right? So that makes it difficult. And I think with the investment strategy, there's a lot of emotion involved with putting your investment dollars on the table. So therefore, a lot of investors kind of wait to see what other investors are doing to make sure they're making a good decision.
So we are going to get into the investment side, and now I would suggest that this is still relevant content for a homeowner who may not be an investor just yet, because you may also want to time the market yourself if you are looking at upgrading or downsizing or altering your portfolio in one way, shape, or form or another. Here's the interesting thing that I noticed, and I'm going to suggest that we actually predicted this, and we can look back at the archives to see if I'm telling the truth or not. It wasn't so long ago that rates were sitting around 2%, and people were buying more than they needed. And I am not a rainy day kind of person. I am not a person who is, I don't believe I am anyway, a naysayer. But certainly we offered caution that said, careful. We are in historically low rate territory right now. This party's not going to last forever. And there are those who bought in March of 22, I think it was, and then the next day, pretty much in April, rates started to go up, and they went, over the period of 6 months, they went up by about 4%, if I'm not mistaken,
roughly,
somewhere around there. Today, those people who may have purchased on a 5-year fixed or a 3-year fixed, those terms are starting to come due. And there are people who are in a really precarious position that they might find themselves upside down on their purchase because house values went down about 35%, or they simply can't afford to qualify to stay in their home. How much of that is actually fueling the market, and why is there an opportunity there?
Well, I think it's important to understand that what we're speaking of is being commonly referred to as the rate renewal cliff, i.e., when is the time when your fixed rate mortgage payments are going to change? And so for a lot of people, they are approaching that cliff where their payment is going to jump between $915 or $1,600 a month. For some of those people who took on maybe $800,000 or $900,000 a month mortgages, they're going to see a substantial jump in their payment, and also they got exposure to some deflation in the market. So those people are hurting right now. They don't want to hear that everything's going well because the rates are dropping, whereas for them, their realization is they've got a paper that shows that their payment is going up, and they can either re-amortize that debt or they can list their house on MLS.
And then you're pretty blunt in that. Let's just call it like it is. But I think we're going to have an opportunity to talk about some opportunities on this show today. And I did say I wanted to sort of set the baseline in this first segment here about understanding where we are. Right now, if we were to timestamp this show, we're looking at now 2 months of increasing unemployment rates. We're looking nationally, and it's quite interesting because we are on the beginning of the rate decrease cycle.
Not only that, we are hitting our winter period when statistically our employment has already come off a hot summer. You know, a large part of the employment market in Canada does have a seasonal ebb and flow to it, right? So employment rate is rising. So unemployment is rising at a time when it's just about to hit a seasonal high as well, which is very concerning.
That is concerning. So again, if you're keeping score at home, there are a ton of moving parts. I'm a firm believer that nothing works in isolation. Everything sort of is connected to something else. But yeah, absolutely. We're coming off of some seasonal highs where you would see tourism or seasonal, whether it's landscaping, pools, whatever it may be, seasonal employment. Yes, there's going to be a Christmas rush for, Christmas employment, theoretically, unless how much of that has been lost to online sales, I don't know. But certainly online sales do play a factor in that. But I guess what I wanted to get at is my personal perspective, and I want to see your thoughts on it, is that we should be really careful about getting too excited about the superficial impact of seeing the Bank of Canada drop its rates. Why is the Bank of Canada dropping rates not as exciting as one might think?
One of the big reasons why that's not really exciting is the Bank of Canada is very reactive to the economy. So they're dropping rates today based on what the economy has been doing 6 months, 3 to 6 months ago. So therefore, if they're dropping rates, it means our economy is in a recession or approaching a recession.
Yeah, and that's an interesting one. I've been saying recession for at least 6 months right now. Again, probably because of what I'm seeing, and as you said, they're reacting several quarters behind, or at least a couple quarters behind. I am a firm believer that again, I've said that now 3 times, I'm a firm believer. I am just beating it into myself. We are actually in a recession, and all of the indicators are suggesting that. Jobs is one. The fact of the matter is that the people who are seeing their homes renew, or their mortgage contracts come up, they're in trouble. They are in tears.
They need help.
They need help. You're seeing divorce happen. Backing up a little bit, people didn't just buy homes. They bought homes, they bought F-150s, they bought cottages, they bought RVs, they bought toys, recreational vehicles, etc. Again, studying the market, if you look at the buy and sell, you're seeing, I don't want to call them assets, you're seeing toys that people bought at a premium during COVID being deep discounted just to get out from underneath the obligation.
Yeah.
So, what do people need to do right now? If you're not an investor, we're not talking to investors, you're just trying to make it work. What do people need to do right now?
I think people really need to re-budget. You know, we've had a period of where money was a little bit cheaper, and people have been able to sort of buy those extra items where they didn't have to watch their bottom line as much. And I think right now we really need to be careful with every dollar we're spending and make sure it's being applied appropriately.
Mm-hmm. Great advice, and it almost sounds like that's like I set you up for that, and I can appreciate if somebody thinks that, but that it's a truth.
Yeah,
it's a truth, and we've been saying it for a while, and I think now's the right time. I mean, before was a great time. Now's just as good a time if you haven't started.
Yeah.
When we come back from the break, though, I want to talk to you about, I mean, there are a lot of people who are actually saying, if you check out social media or if you read the editorials in the newspapers, et cetera, and I know I've said don't read them too much, right? Pay attention to your own budgeting, pay attention to your own reality. But there are a lot of people, the sentiment out there around the kitchen table is, my kids are never going to own a home.
Yeah.
We typically have been generationally buying back into our neighborhoods that our grandparents and our parents lived in, and we might disappear for college or university or maybe to test the waters in another area. We typically do come back. There are people who are saying it's not possible. I cannot afford to live in the neighborhood that I grew up in. I want to talk about that, but I want to talk about, when we come back from the break, the opportunity for someone who until now thinks that they or their children will not be able to own a home. You're working on something, you've made it a part of your portfolio for about 10 years if I'm not mistaken, and suddenly it's going to come into vogue. My crystal ball suggests that it's going to come into vogue. Let's talk about that when we come back from the break.
Love it.
So, if you are thinking about getting into the market or wondering how you are going to get into the market and how it's even going to be possible, I'm going to suggest you stay tuned, stay with us right after this break. We'll be right back. Welcome back to Hitting Home, and it's a great conversation I'm having with Ben Oakes, who is a mortgage agent and an investment strategist specializing pretty much in central and northern Ontario, I think is worth saying, Ben, right? And we're talking about, or the goal is to get us towards talking about opportunities for growth. That's what it says on the bottom of the show, and we will get there, but I think it was important to kind of set a baseline of where people are, to be a little bit, matter of fact with where we are with some of the decisions that we've made. And this is not a conversation to be had to any one specific individual. It's a bit of an assessment of what the consumer has done, how the consumer has acted in the market historically, leading right up until today. And we're observing what some of that repercussions, good or bad, have been for many people. But I do want to get into that opportunity. We sort of left off the last segment talking about there is a growing sentiment that home ownership might be out of reach for some, certainly upcoming generations. And if you look at We just talked about unemployment. We didn't talk about it, but during the pandemic, we saw a lot of people who dipped their toe into self-employment. And again, during that period, Mike and I had a conversation around be careful what you do of jumping out of your job and into self-employment, because if you're going to qualify at the bank, you need to show some consistency of income. You need to prove your model. But people have done whatever they've done. The fact of the matter is, though, that not all hope is lost. And that's really what I want to talk to you about today. I'm willing to suggest, though, that regardless of what strategies might have worked for previous generations, we've said this for a while, that doesn't mean that that's a strategy that's going to work tomorrow. And I think we're at a very pivotal moment in society when it comes to household finances and buying power that people really need to take a look at what are some new opportunities for growth if we were maybe to leave some of the old practices behind.
Yeah, and I think that's really important to establish, like you said, a baseline, whereas even in the experience that we have, when I first started signing mortgage clients, it was predominantly one person signing. And all of a sudden you're needing two people to sign for the average mortgage. And all of a sudden you're needing a larger down payment gifted from, the bank of mom and dad plus two people co-signing. And all of a sudden you're needing mom and dad to gift the down payment and also go on the mortgage. And all of a sudden you're needing mom and dad to remortgage their house, go on the mortgage, and really leverage themselves in order for their children to be able to buy. And what we're seeing is the average age of the first-time home buyer is creeping up and up and up and up, and I believe it's somewhere around 36 or 37 years old, where this is a whole new generation of young working professionals. No matter how much they make, they're not going to be able to buy a house until their early to mid-30s.
If you go back not so long, 2 decades is not a long time in the grand scheme of things. There were people buying at 18, 19, 20 years old. They may or may not have skipped the college and university route. They may have gone into the trades directly, and they were purchasing their first home, in their early 20s. That's a more rare scenario today. Now, here's the thing. Sometimes the fastest way to get ahead is to not actually look at how to get ahead, but to look at how to actually stop the bleeding. And you did talk about that scenario that at renewal, some people are realizing that they have to turn in their keys. They're negatively amortizing. They're upside down on the value. They owe more than the house is worth.
Yeah.
Or they are outside of the legislated limits of how much a bank can lend, right?
Well, that's a big one too, because we were told that the stress test was going to make sure everyone was okay at renewal. And unfortunately, even if they managed to qualify at that 5 or 6%, that's not meaning that they can actually fulfill that budget.
Well, there's a really good marketing campaign out there that said, it wasn't us, don't blame us, it was global inflation, and there's nothing farther from the truth than that. I mean, the fact of the matter is that those who make set rate policy could have made adjustments much earlier than they did to slightly increase things and create that buffer. Basically, what it comes down to is we spent our reserves, and we had no money to recover those reserves, so we had to actually increase more than we would have if we had incrementally increased sooner.
One of the things you mentioned, which is interesting, is that it is a worldwide problem. So worldwide, we saw the problem sort of roll out uniformly-ish, but it's also a much more decentralized solution. So different governments have made different tweaks to their economy and reacted at different time periods. I think we can take a look at how Canada first reacted and then recovered, and say some other countries have been a little bit more successful, and maybe we can start to emulate their practices a little bit.
Absolutely. So let's take a look at some things. Now, for some people are going to be going through a down season, and they may find themselves renting, and renting is really expensive. There are others who have moved outside of the home sort of radius, their jurisdiction, to look at cheaper homes elsewhere or renting elsewhere. Renting, interestingly enough, hasn't necessarily sort of kept pace with home ownership. In fact, we've seen home prices go down, we've seen rent go up. We go ahead, Ben.
Be careful where you say rent's headed, right? I think we've seen that Canada's really slowed down the immigration policy, regards to how you feel about the timing of that. I think we've established that it's been too much, and so things are slowing down. And also, as the rates go up, The deflation, like you mentioned, hasn't really hit the rental market yet. There's a delay there because there has been a large rental pool, and now I think as the market comes back on and we see people exiting the rental pool and making those purchases, I think that we're really going to see some much slower growth in the rental market. And even my property managers here in Barrie are saying we're seeing more units available for a little bit longer.
Now, and that's interesting that you say that. What is fascinating to me is that the conversation continues to be about the immediate pain point and not necessarily about the root causes of the challenge. And you talked about pulling back on immigration. We've heard that regarding universities and colleges having their caps sort of lowered and reduced. Yes, we need new blood in this country. We have a generational cycle. We've got more people retiring than ever before. We need the labor and talent in order to continue to move the economy along. But it's almost as if the one hand isn't talking to the other hand to sort of get things in stride. And so now we're saying, let's pull back on immigration. Well, the immigration challenge wasn't necessarily only the immigration challenge. It was the fact that we didn't have construction happening at the pace in order to keep up with immigration. So what happens when we actually pull back on immigration? Sure, we might see something sort of soften or relax momentarily, but what's the negative impact, or now I just planted that seed with you, but what's the impact down the road of pulling back on immigration?
I think we're going to see, I hate to say the word, but a little bit more stagflation in the growth of the economy. And Canada is really a country that doubled down on the growth of the real estate and associated transaction as a part to grow their GDP over the last couple of years. And now I think that runway has run out and we're really going to have to transfer to being a productive country again.
I think that's exactly what it is. We have continued to deploy strategies that are reactionary as opposed to proactive. So it'll be interesting to see how our leaders lead us into that next season. Let's talk about what the average individual can do who is saying, I don't know if I can afford it. And I planted the seed with you earlier. Let's look at strategies that differ from what our parents or previous generations did. What are you focused on when it comes to, let's stick with the single family, the person who's looking to buy a home. Traditionally what, and today what?
I think that really one of the strategies that we're going to have to take a long, hard look at is cohabitation. And even before this happened, I like to work with investors who are young and hungry and said, hey, I've known Alex for a really long time. Alex and I are going to buy a duplex together. He's going to live in the upstairs apartment. I'm going to live in the basement apartment, but we're going to co-own this house together. 3 or 4 years down the road, they can sell that and each have enough money for their own down payment. Or if they really enjoyed the process, they can refinance and do it again and buy one or two more. It's a really great path to real estate ownership.
This isn't new.
No, it's not.
There's a guy named Robert Kiyosaki who actually wrote about this probably 25 years ago plus at this point, and when he wrote the book Rich Dad, Poor Dad and Rich Dad's Guide to Investing, etc. What's the difference? What is he talking about? What's that principle that you're actually deploying today and you have been for some time? What is that founded in? And talk to me about delayed gratification, basically.
Delayed gratification and compound interest go so well together because they both take time. And I think you're really holding off on what you want immediately for a longer benefit down the road. And I think the longer you can hold off on that perceived benefit, the bigger it's going to be. So we're in a situation here where, if you wanted to buy by yourself, you would have to wait a significant amount of time and you might miss out on this bit of a bull market that we're approaching over the next 6, 12, 18 months. Whereas if you bring in a partner, or an investor on some level, whether it's a friend or family member, now all of a sudden you can get into this market. You're not paying rent, which is completely a write-off. You're building equity in an asset that is capital gains free, right? And that's another one for a lot of people.
So I do want to get into those changes in just a moment regarding capital gains, et cetera, but again, bear this in mind, okay? There are people who 2 years ago, when the market was going crazy and interest rates were down around the 1.92% rate, they're like, I'll never own a home, right?
Yeah.
Housing values, implied values, inherent values that we saw were actually a bit of a bubble, continued to rise, and the market's great, interest rates are low, but I can't get in because I don't earn enough money to be able to buy that $750,000 house that's currently selling for 1.2.
Yeah.
right? So now on the flip side, rates are high, housing prices have come down, but I don't qualify because of the qualification criteria. And by the way, I also spent all my money as a consumer. I wasn't thinking as an investor. Just get us touch on the topic. We'll have to come back from the break and pick it up. What is the difference in the mindset of a consumer and an investor starting point?
I think really a consumer is emotional based. They're thinking they want their dream home in the best location. And I think an investor really looks at the napkin, the math, the black and white. There's no gray areas. It either works or it doesn't. And so I think once you approach housing as an investment, you start to realize that perhaps you won't be buying your dream home, the first house or the second house that you own. It'll be more of a process of slowly moving up strategically based on your family's growth, your career development, et cetera, and understanding that the average Canadian now owns, 3 or 4 homes throughout their transition as a homeowner.
Yeah, absolutely. It was around 7 years or so we're typically flipping or buying out of one and into another. So the idea that was planted in people's mind that, buy now or you will never be able to buy, you still think that's false?
I do think it's false, yeah.
Yeah, and I think actually for those who were panicking in 2017, they just had to stick around until 2018 to see that it came down. Those who were panicking in 21 and 22, I think can see now that it's come down. The question is, how disciplined are you and I willing to be?
Yeah, and one of the nice things about house prices coming down is they've come down to the point where rent is starting to cover the accommodations. So in Barrie, our local market, we saw the price of a duplex jump from maybe $650, $700 to somewhere around $1 million for a legal duplex if it was fully finished. And now we're seeing, of course, the rent was not going to cover that mortgage payment, right? And now we're seeing the prices come down to the point where rent will normalize that mortgage payment.
Perfect. When we come back from the break, let's dive deeper into what it looks like as a first-time buyer or a younger buyer in the market to actually get into home ownership as an investment strategy towards that opportunity for growing that portfolio.
Sounds good.
Sound good? All right, we'll be right back after this short break. More from Ben Oakes. Welcome back to Hitting Home. Ben, we're talking about opportunities for growth. And I think that's the key. That's the key throughout. And there's some stuff that we're probably sharing that, it's rubbing people a little bit uncomfortable. They may not be loving it. And I think that's fair. And I think that's fair, and I think we should double down. Let's double down right now. Fact of the matter is, if you look at the stats and you look at the numbers, when we see polls, when we see census being taken, when we look at reports coming from the bank, when we see reports coming from TransUnion and Equifax talking about household debt, these are indisputable trends. How we got there, open for interpretation. The individual story, open for interpretations. Sometimes life happens to me. Sometimes I'm accountable for how I carry myself and conduct myself in life. We're talking about opportunities for growth, and not everybody's going to get it, and not everyone's going to seize the opportunity. Why? Age-old story, if everyone's doing it, it's no longer an opportunity. So let's talk about the opportunity for those who really want to get into home ownership and are willing to stretch and change age-old thinking, and are willing to do a little bit different. Why is there an opportunity?
Well, I think identifying that there is an opportunity is important. I think the opportunity zone has changed considerably. Back to that book you mentioned before, Rich Dad, Poor Dad by Robert Kiyosaki, it's been out for a long time now, but one of the things about homeowners and investors that surprises me is they want someone to do everything for them. They want the perfect opportunity. They want everything spoon-fed to them, whereas, really understanding that Not everybody's going to be good with their credit or managing money, and I think there's a lot of steps that you have to get together first before you even see what an opportunity looks like. And if you haven't had the coaching or the learning to sort of identify what home ownership can look like as an investment strategy, you might miss some opportunities and kind of stay where you are and never progress. And so it's important to understand that even though first-time home buyers are now getting older and older, the path to home ownership still is there, just the barrier is a little bit higher. And so arranging your mindset and your finances and your credit, I bought my first house at 23, and that's just not feasible anymore. If I was starting it again today, it would be much higher, not impossible.
Not impossible, and that's the key. I'm probably going to tick somebody off at home right now when I say this, but it is a fact if you actually look at what I'm about to say sort of critically and strategically. And Robert, I believe, says that in his book, but I don't remember if it's the first book or the second book. He says, owning a home for personal use, your personal home, careful who you listen to and what you understand about home ownership. Because home ownership for your personal home is not an asset. I'm going to say that again. Owning a home for your own use is not an asset, because it defies the actual definition of what an asset is. Owning a home is a liability. And why it's a liability, he says? Well, because you don't own it. The bank owns most of it for most people under most scenarios, especially if you're putting 5 or 10 or 20% down, the bank owns most of it. If you stop paying the bank their interest and principal payments, the bank will come and leave you a letter and eventually take your home from you. So while you're living in your home and paying it down and off, unless it's income producing and cash flowing positively, that home is a liability until you put a for sale sign up and that for sale sign says sold, and you walk away in a better position, as in you walk away with something left over. Then it's an asset, but only at that time, not during the carry.
Which is a bit of a counterintuitive mindset, because mainstream media and the way that our parents always spoke was your home is your biggest asset you're ever going to own. It's the biggest transaction you're ever going to do, and therefore it's the most emotions wrapped up in that transaction, right? So people start to forget the lessons they've learned about money and about budgeting and about being careful with how much they're committing to their monthly obligation. And so I think it's important to understand that there's a full range of growth that needs to happen before you should approach owning a home. It's not just, should I rent versus should I buy? It's like, I have to rent now, and for a couple of years perhaps, until I get my ducks in a row. And I think more and more people are starting to understand that.
So let's get into that purchase, let's get into that first home, but let's look at it from the perspective that you're suggesting and you've been discussing with your clients and potential client base of home ownership as an asset class through investment. Let's talk about that, and let's talk about it at a very basic level, which might be, as you talked about in your scenario, getting in with a friend or a complete stranger. And just so that we're clear, you and I are not lawyers, we're not accountants, and we do not offer legal or accounting or taxation advice.
Correct.
However, talk to your lawyer, talk to your accountant about things like not joint tenancy, but tenants in common, and getting into business with either a friend, a family member, or a stranger, and how you can protect yourself so that it's actually a legal, in writing, registered on title business transaction. Let's talk about that very first home, whether it's a single detached that maybe only has one unit now, or might be a duplex.
Yeah, that's a good point. I think I've always been the mortgage guy who would present having tenants on your property as a good strategy for an investment. And a lot of first-time home buyers just can't find that palatable, so they do their single-family home, and they don't want to deal with tenants, or they don't want to deal with parking lots, or snowplow or garbage or anything like that. And so I've always been the guy to kind of pitch that on them as saying, you're not going to live here forever. Let's pitch this as an investment strategy. So, we find a spot where we can add a unit in the basement and we can legalize it and use that cash flow. We can add an ADU or additional detached unit in the backyard, or perhaps there is some zoning about your property in particular that allows you maybe even more density than that.
So even the municipalities, we're in Barrie right now, but there are other municipalities units throughout the province and the country that offer secondary suites or garden suites that are, I think, somewhere around 500 to 750 square feet, something in that range. There are multiple opportunities, and there's even incentive programming out there for people to take advantage of. Why? Because there is a demand for rental units. There is a demand that is not being met by the construction or the development community because of inflation, because of the risk associated with it. We'll talk about risk in just a moment. But it is more accessible than ever through cooperation and programming to actually build a second unit on your home.
Absolutely, and I think one thing people understand is I don't have to go buy another piece of land or another property to add more value to my existing structure. And so, sometimes it's, just as important to identify that if you do have some capital, it might be better spent investing into your home the way it is now, so you can add a basement suite or a unit or two in the backyard, and then eventually, refinance that or sell it and buy the house that you actually want to live in.
So if you've got a partner, a spouse, a family member in your home, and either you or they are saying, well, I don't want to have strangers living on my property, we live in a weird, then this isn't for you. Plain and simple. Unless you're willing to change your mindset and realize, I'm making a decision, this is not going to be my forever home, this is not where I see myself in 5 or 10 or 20 years, this is not how I want to retire. In fact, I want a retirement vehicle or mechanism. I'm not getting a pension. I'm not getting any younger, and this is something worth exploring. Then this is for you.
I think that understanding what we talked about originally, delayed gratification and sacrificing a little bit in the short term to have that long-term goal. If you look at where you want to be in 10 years, you can work backwards from that and say, for 24 months, I'm going to have to live with tenants. It is what it is. And yet you're still owning a home, you're still building equity, and you're still building your investor trajectory that way.
Okay, this is not meant to be a pitch for you and me. However, for the average person who might be thinking about doing this, for them to walk into their branch and say, hey, I've got this great idea, we know that they're likely going to be met with or by someone who's not an expert in investing. Why do I know that? Because you and I both know that less than 2% of people who do what we do actually do investment properties and construction financing and things like that. Yeah. So the person at the branch likely isn't that expert. Talk to me about the word risk and risk aversion and risk assessment, depending on which side of the equation you're sitting on.
Risk aversion is tough because no matter what type of opportunity you're presented with, you're not going to see it, And so really being able to open your mind to what an opportunity looks like is very important, Without that opportunity zone being shown to you on paper, it's not something that's taught in our school systems. It's something that someone like you or I has to sit down and teach people, or else they're just not going to learn it, right?
So, talking to the bank, they're going to likely throw some cautionary flags. And the reason being, and I'm just going to flat out say it, and they're not wrong, their primary goal is to protect their shareholders. Their primary goal is to make sure that the amount of money that you borrowed on your mortgage gets paid back. You deciding to go into an investment and have additional exposure to what is defined as risk is not their comfort zone. So what is it that you can educate people on in terms of changing or introducing new math? And it's not new math, but a new look at math from an investor's perspective. What are you teaching people when you're introducing them to an investment opportunity?
Yeah, and that's a challenge because for a lot of people, they haven't really set up their budget to accommodate an investment that requires money from them. So this is a big mindset change for a lot of people, which is important to understand. If you're already where you want to be, then you don't have to change. But if you want to be somewhere different, you have to take on some new behaviors and grow through it, right? So really understanding that there's a strategy to be used that is pretty fail-safe. It's been done by many more people other than us, and very, very successfully. Is very open to people once they open their mind and start educating themselves and seek out education from professionals in the industry. That's our job, to educate people, right?
So if you were to meet somebody and they said, Ben, I'm all in, let's do this, would you be introducing them to the idea of trying their testing the market or the waters right where they live? Would you look at a different geographic jurisdiction? Would there be a specific asset class? Would you look at a single family dwelling or a product that has a secondary suite, or would you take them right into some multi-units?
I think it's important to establish that there is an investor journey that you have to go down and you can't skip. I think every investor, no matter how much money they have, needs to do a duplex or a triplex, understand what it means to work with tenants, to accommodate tenants, viewings, contractors, learn how to work with a property management company, and build your team of professionals before you jump on your first multifamily building. And so identifying that just because you have capital or access to capital doesn't mean you can skip all of the small lessons needed to be successful.
Mm-hmm. So we're about to go to break. My takeaway one more time, those two words, delayed gratification, to walk into this new concept, and new for some concept, should not be taken with an attitude that says, I'm going to go do this thing and we're going to be rich. There are going to be likely some long days. You might be acting as a landlord or a property manager for yourself until you can afford one. But again, you talked about the journey towards growth, the journey towards growing your portfolio. When we come back, I want to touch a little bit more on multi-units, the concept around multi-units and what you've been working on, as well as touch on being an investor, not as the landlord, not investing in the real estate with your name on title, but a different type of investment. So stick with us. When we come back from the break, more from Ben Oakes on in real estate and investment as a growth opportunity. Stay with us. Welcome back to Hitting Home. And Ben, we're continuing to have this, to me, it's an exciting and fascinating conversation around the opportunities. And opportunities investing in real estate, investing as an owner, investing as an owner for personal use versus for investment portfolio growth opportunity purposes, investing. We're going to talk about this next class where you actually aren't necessarily getting into purchasing property itself, but we'll get there in just a moment. Takeaway, I think if I want to offer anybody a takeaway, it's there's always going to be an opportunity. Whether the market's trending higher or trending lower, there's going to be an opportunity. It's going to depend on how you analyze it and look at it. The other thing is, if you're looking at it for opportunity, you can't get emotional about it. You're going to win some, you are going to lose some. And in the equation, there can be a winner. There can be someone who's not a winner. I'm not going to call him a loser. Sometimes you have to take advantage of the fact that you were prepared to act. And in this scenario that we talked about right at the beginning of this show, where some people are coming up to mortgage renewal and realizing they can no longer qualify to stay in their own home, if you're prepared, you're not taking advantage of that person. You're prepared and taking advantage of that opportunity, but you're helping that person get out from under their negative situation so that they can start fresh. And I think it's important that we talk about that for just a second in this final segment of this episode, is that you got to make sure that you are clear in your own conscience about why you're doing what you're doing and that you have a plan to get there. Go ahead.
Not just that, I mean, there's a lot of limiting beliefs that we have to get through when it comes to putting our hard-earned money into real estate, right? Yes, no one wants to take advantage of everybody, but we're all looking for that opportunity zone, and it's got to be a win-win situation, right? And speaking of limiting mindsets, Robert Kiyosaki, he was amazing in that book. He taught me so much. I'll always give him the credit for that. But some of the things that he does say in that book no longer serve me as an investor, which is interesting to isolate. One of the things he says is always buy a property that you can drive to really fast if something goes wrong. And that's no longer something I believe in or teach my clients who are investing at a high level. We want to invest where the opportunity zone is, not just where we are stuck strategically. And so one of the things I help coach my clients on is becoming a satellite investor, learning how to build a team, that you can rely on of 3, 4, 5, 6 different professionals, so therefore you can buy where the opportunity is, not just where you are physically located. And people ask me, what happens if, something goes wrong, 3 hours away if I buy in Sudbury? And I say, well, why would you drive to the property unless you're a licensed plumber or a property manager? There's professionals, that's their job to take those situations seriously and sort them out for you. In fact, there's a good chance you might just be getting in the way if you were trying to deal with things on the site, right? So there's professionals in place to help you go through your growth trajectory as an investor, and I think avoiding those learning professionals would be a mistake, because it's going to really skyrocket your trajectory as an investor.
Yeah, it's so true, Ben. I'm glad you brought that up, the importance of getting out of your own way. And again, we're coming back to the whole point of removing the emotion from the equation. Everything that you talked about is basic math. Mm-hmm. It may not be the simplest of math, but it is basic math. And when you talk about it, well, one, I'm not the licensed plumber, I'm not the electrician, and also I'm not going to drive 6 hours, 3 there, 3 back, and then my time on site if I'm not the expert. When Kiyosaki wrote the book, the internet wasn't what it was today. We didn't have drones, we didn't have Zoom calls, we weren't as connected. The world has become a much smaller place, and in the mathematical formula and the equation of joining others in the investment, as long as you're willing to set your personal greed aside, that you don't need to have it all for yourself, and you're willing to take your percentage-based wins spread across potentially multiple units or multiple properties, yes, absolutely, you've got some additional security in the expertise of your partners.
Really important to understand, absolutely. And also important to understand, once you go through that growth of identifying opportunity zones, and you can now look where you don't live, you can say, okay, this is the rent in this city, and this is the cost per unit in this city, which is different than where I live. There must be a delta there of some point that maybe I can make a profit on.
Let me break that down into plain English real quick. There are some locales, some jurisdictions where rent barely covers or doesn't even cover the mortgage payment and the property taxes and maybe 5 or 10% for some maintenance and insurance, etc. And then there are other jurisdictions where the land values are lower or the cost per square footage to own is lower, but the rent is still the same as elsewhere, and that's that delta that you're talking about.
Absolutely. So you really want to do a significant amount of research where you're buying strategically. What's the average age and rent amount and the income amount from that location, because the internet, you mentioned, we have so much data to analyze. We don't have to make an emotional decision when it comes to investing. We can make a very logical, educated investment strategy.
So, you know what, you reminded me actually of the very first home that I purchased as an investment property, and I was emotional. So I had read Rich Dad, Poor Dad. I did have a rich uncle or a rich dad, but he hadn't imparted all of his wisdom on me, and I was so excited, and my wife and I at the time were talking about it. We're like, we're gonna be the best landlords ever, and yes, you should be the best landlord ever, but what does that look like? What does that mean? We're gonna renovate this place top to bottom. We're gonna have the finest, front load washer, dryer, brand new kitchen, etc. And we went all in, and we said, we're gonna create a beautiful home for somebody. And that's admirable, that's noble, and the math did not work. That does not mean, hear me loud and clear, that does not mean be a slumlord. That does not mean be a bad landlord, but the math has to work. And so sometimes you've got to, I think the takeaway was, if I'm buying it for myself, then I am solely accountable for the upkeep and the math to work.
Yeah.
But as an investor, I'm not buying it for myself, and I shouldn't think that way.
And I think also as an investor, you've got really two choices. You can go for, an under 2-year kind of flip situation, or you can go for an over 2-year, more of a buy and hold, stabilize the rental situation. And really identifying which investment strategy you're going after is important, because, in a situation where you are going to max out the fit and finish of the renovated property, you've got to do your research and say, what's this going to sell for, at the peak of the market next March?
Or if we have a vacancy, can we carry it?
Yes, absolutely.
Ben, in the last few minutes that we have, talk to me though about what it takes. If I'm watching you right now and listening and doing some math and thinking, I've been thinking about this for a while. what are some very preliminary steps that I should be taking? What's a self-analysis I need to do, or what are some questions that I need to ask myself to decide if this is something I should inquire about or pursue?
Yeah, absolutely. And this is a great question because a lot of people come to me and say, I don't have millions of dollars, but I have, 250, 300K. I don't want to watch it disappear in the stock market. I want to invest in real estate. I just am not necessarily sure how. And then we take a really good look at where they are in their investment journey and their knowledge journey, and see what milestone would be a really great checkpoint for them as an investor to start at and then build their experience on. And for some it might be a construction project. For some it might be just a renovation project. And through each of those experiences, the real big thing that you're building is not the project itself. It's you as an investor growing and learning how to solve problems and face challenges in real time.
So as you're speaking, I'm listening to you and I'm thinking to myself, well, okay, first and foremost, 250 to 300,000 might be a big stretch for some people who are watching, might not. That's great, call me. No, but that's interesting. But for others who might be considerably lower than that, I think it's important to realize and to understand that it may or may not be the client that you're working with, but at every level there may be an opportunity. Now, at every level that makes mathematical sense, there may be an opportunity. But as investors, you can go into buying your RRSP, you can buy your TFSA, you can buy a GIC. There's lots of products out there. Speak to licensed professionals. And real estate is a class that you can explore. But there are some big differences, and I think one of the takeaways that I've learned throughout the years, if I'm gonna make it in the stock market, I better be a really good day trader. Because those are the people who make it, and they spend 24 hours a day. They are glued to their devices and reading the data and making moves.
And the big moves might only happen on 2 or 3 days of the year. And if you miss that day, you're going to miss the big move.
Exactly. This is a different product. And it is possible to participate in this asset class as an investor if you don't have all the money yourself and you're willing to partner with either people or strangers under some pretty strict regulated guidelines. You can make it without even having $200,000 or $300,000 in the market. You can start.
Absolutely. And I think for most people it's going to be, how do they get into their first home? That's where most of the demand is. And if they can hold on to that for a couple of years, they can pay down the mortgage, they can keep their credit high, they've built out some relationships with tradespeople and perhaps some management or paralegal, to identify what happens when problems happen, right? And so you take that silo of growth and then you start to stack skills on top of it. And once you hit a problem, you say, oh, what happens here? Okay, well, I need to call this person, I need to call this person, we solve it as a team, So really understanding that wherever you are, there is a project that's just your size based on the lessons and the experience that you have. And I would really, tell most people there's no reason for you to do a project by yourself.
Great, and there is a takeaway I'm going to take from that as well. When I started looking at stocks, and it's not my area, I don't do it now, to be completely blunt, I'm not a day trader, I played with monopoly money. I actually just tore pieces of paper and wrote it down and I tracked it. You don't have to dive in now just because you're excited. In fact, wait for the excitement to wane just a little bit so you're not emotional. Track some things with some monopoly money. Follow the project, whether it's day trading on the stock market or looking at real estate. Now with real estate, you got to watch the time, the market, et cetera. And we got to go. I got to wrap this up. But it's okay to track this on paper only for your first one and then decide that you're building your understanding and familiarity.
This goes back to the basic first-time home buyer. Once I meet with a first-time home buyer, they're generally not buying next week. Generally, there's some income or credit discrepancies that we have to grow through. And so I say, well, this is going to take 6 months before you can buy. But meanwhile, instead of just paying your rent every month, I'm going to get you to set aside that mortgage payment that you're going to start making in 6 months. And that way, they've already got the mindset of, okay, this monthly obligation is coming down the road for me and I need to learn how to accommodate that.
We gotta go. Ben Oakes, mortgage investor and strategist, thanks for being on the show. We'll see you next time.